Hello students, welcome back to the index model of portfolio management. So index model is comprised of the market index and the active portfolio. How much portion, how much the weight we put on the market index, and then how much percentage on the active portfolio. But before jumping into this class, these extra exercises of constructing this index model, you must read these class notes and understand all these equations and the flow of this single index model and the portfolio model with this the construction in the index. You must understand all these equations first and come back to this exercise. Otherwise, this exercise is useless. Or you can read the textbook, the chapter 8. Chapter 8 is one of the highlights of this the textbook. Please read this textbook, suggest textbook, this chapter. Also, you can read this the slide made by the publisher, but I strongly recommend to read the textbook first. Textbook plus these class notes. You must understand first. Okay, then let's get started. Here, panel A shows the risk parameter of the investment universe, and the correlation residuals is just the peripheral information to understand the relationship between the securities. And the index model covariance matrix, we are going to use this covariance matrix to build the optimal risk portfolio model. And the market risk premium, we have here the macro forecast and forecasted alpha. This alpha is really important because that explains the excess return of the historical excess return of the securities, but it's also given. Who got this number? You must calculate your excess return based on your strong assumption, reasonable logical assumption. Also here, the standard deviation, how long period you use to measure this standard deviation. What about the beta, weekly or monthly? So you must justify. Standard deviation of residual also given. You must explain the reasonability of the given information when you work as a security analyst. And then here, total risk premium we calculate. Finally, optimal risk portfolio. Again, the point is here, what is the weight of each individual securities and active portfolio and the market index? And finally, optimal portfolio will show the beta and risk premium and standard deviation and Sharpe ratio. Again, we are going to use this Sharpe ratio to find the maximum Sharpe ratio to find the optimal the combination of risk premium and the standard deviation using this equation or using the server. So let's get started. Standard deviation of systematic components, the relationship between, right, this is the standard deviation of excess return and the beta. Beta is unique, the sensitivity. We'll apply this beta to the standard deviation. So standard deviation of systematic component, only the systematic component, right? So how to calculate it? Right, this I want to fix times the beta. So let's take that down. So we collected the standard deviation of systematic component. That's why we use only the standard deviation excess return of the market index. But we apply the beta of the unique beta of the individual the securities. Now this is given the correlation with the market index. Take a look at this equation of the correlation. If we change this the correlation the return part with the market, then this beta market, this beta, the standard deviation in the denominator is also market, then we can remove this. We can remove the beta. So only remaining is beta, and the standard deviation beta a standard deviation of the market, and denominator we have only the standard deviation of the individual stock. That's why we can use it simply. That's how we can use this. The equation just simply the beta of the market, right, times standard deviation. Want to fix divided by, now let's open this standard deviation. Only have one standard deviation of the securities here, so that when it drag it down, and we have all the correlation with the market index. This D12 is the beta of the individual stock times now the beta of the market fixed divided by the standard deviation of the individual stock, right? So we got this. Okay, so this part is just for understanding covariances, the correlations here. The correlation of residuals between the Walmart and the Target is fairly, right, positive, almost closest to 1, because they are on the same the industries. Just for some information here. But here, covariance metrics, as we the practice the last the session for the Markowitz full variance and minimum variance model, we need to calculate our covariance metrics here. So again, on the class notes, or the class discussion, how to calculate covariances on the index model. Index model, point of index model, is not only the relationship between the two stocks, right? The relationship between the market and the stock with the residuals, right? So we use these covariances of this combination between two, and then we come up with the beta of the individual stock, right? From the market, the standard deviation. So here, how to get it? So let's calculate. Let's calculate here the beta equal beta times also the beta of the Walmart. Now times what I need, right? What I need here is the market standard deviation, right? Market standard. Is that the covariance? Oh, sorry. Is that the variance or covariance? Doesn't matter. It's just the variance, because market index, we are going to use here the market, the standard to the power of 2, which is the variance of the market. It's just the variance. It's not the covariance. It's just the variance of the market. So we want to fix here. But I want to make sure if we can use this. Okay, C column fixed and 27 row fixed. Okay, so let's fix 27 fixed. Then let's just drag, and let's drag down. Okay, so it doesn't produce anything because the index, the market index, the covariance, the variance of the market index, nothing, right? So let's get, what is the variances? The standard deviation, right? This must be now the standard deviation to the power of 2, which is the variances, this part, right? And then we got this, all this part, right? But again, when you calculate this covariance between Walmart and Walmart, doesn't have to get the covariance, because the covariance of the Walmart and Walmart is the variance, right? So here, this or this part must be now just the variance. So how to get it? Now the variance, which means the standard deviation to the power of 2. Next, also the standard deviation of target to the power of 2. In the same way, horizon to the power of 2. Target to the power of 2. And finally, we need 2 more. So we got it. So we finished this covariances matrix. Now let's move to the market risk premium part. Again, this alpha is excess return from beyond the market index. So we need to calculate this and should get from the historical data. So there are very kind of less subjective area in this field. But the alpha actually generate excess return at the end of the day, right? So here, the beta we collected from above, and the total risk premium, how to calculate this total risk premium? Yeah, risk premium, which is excess return alpha plus beta times, right? Here, the market risk premium. So here, equal alpha plus the beta times the market risk premium. You got it. Market risk premium, how to get it? Yeah, market expected rate of return minus risk-free rate. And we want to fix this so that when I drag to the right, okay, we got here the risk premium of the individual, the stock. The total risk premium of the market index itself is the market risk premium. Why? Because there is no alpha, and the beta is just 1. Now, once you complete this panel D, then let's complete optimal risk portfolio. Again, the point is to get this weight or the individual weight of the stocks in the active portfolio. We have 3 portfolio. Over the portfolio that includes the market index and the active portfolio. The active portfolio. So here, active portfolio A, once you complete this, market index portfolio automatically created, right? So how to get it? First, the optimal risk portfolio. Optimal risk portfolio means the residual variances, right? Residual variances of the securities. So let's get this. First, where do we get this? We need to get the standard deviation of the residual, right? Standard deviation of the residual, but we need to get multiple. The scale, which is the variance, residual variance of securities. So here we have a standard deviation, there you go, right? But we need to scale. Here, what function do we need? Here is on the, right? This is vertical, but this area is the horizontal, right? So what function do we need now? Right, transcope of, please be careful, what we are collecting is only the active portfolio securities, right? Active portfolio securities, be careful. Do not include the market index. So once you scared, then now all these numbers is from, right, standard deviation to the power of 2 from the Walmart. Okay, once you got this, the square root, and here now initial position of the securities we want to calculate, based on here. This is also one of the important point here. The alpha divided by the standard deviation, the variance of this error. That explains the initial position. If you take more the variances, then we want to find higher the alpha, right? Compared to this, the weight, we want to find the largest, the performance. The alpha over the variance of this error. We want to put this weight with this highest initial position, right? So let's calculate, which is the performance part. Where is the alpha? Now the alpha of the Walmart divided by, right, now there you go. So once we got this, 0.54 is not the weight. It's not the weight. This is just the position using this performance alpha over the variances, residual variances. So let's get this all. So by doing so, we can find which one has the highest one, this performance alpha over the variance of the residual, the error. So we found this, right? Then what is the total sum of this all? The sum of this all the positions. Again, this is not the weight, but we'll definitely convert this position into the percentage, right? Percentage. So where do you get it? Okay, so it's slightly oh, I made a mistake here. I'm so sorry. So I collected the standard deviation of excess return. Oh, no, it's not the standard deviation. But what you're calculating is the residual part. Yeah, sorry, yeah. Because the market, the standard deviation of excess return is not the part of the residual part. So what you want to calculate is the residual part. So here we need to get, okay, let's remove this and then let's calculate again. So transpose of the error part, right? The residual, the standard deviation and residual part. So we need to, okay, include and then to the power of 2. So now we calculate. Again, please remember, when you calculate this, the residual part is not the standard deviation of excess return. And yeah, this part is the residual variance of each securities. So once we got it, and then the rest of them are the same. Now we need to scale by 100%, right? Then how do we scale the scaled initial position of the securities, right? We can just calculate divided by, so this is the position, right? But I want to fix this. Then let's just drag. So by doing so, this is finally the position, right? In the weight of the total 100%. The sum of all this, the weight must be now 100%. So using this initial position of each securities of this residual part of the performance, then yeah, we can get this scaled 100% scaled initial position of each securities. Now, let's calculate the scaled initial position of each securities. So you can just now multiply. Oh, sorry, to the power of 2. So we finish it, this residual part, and so that we get the weight of the residuals. Now, this residual, now the variance of active portfolio, here, how do you get this? Now we can use just some product, right? Some product. Now this variance of this residual variance of active portfolio, we can calculate some product. Some product of Walmart to the GM, comma, and the squared part, because what you are calculating is the variance, right? The variance. Now with some product, and then we got this, the residual variance of active portfolio. We need to now calculate the alpha of this active portfolio, because we now have this, the weight, we have the alpha, so we can calculate, right? So here, also the same way, some product of this alpha, comma, and then weight. So we have now here the alpha of active portfolio. The portfolio alpha is 0.02, right? And exactly same way as we used here, we used as a performance, we use this alpha of the active portfolio over now the variance of this residual active portfolio. So let's use this outcome now to get this one. Okay, we're almost done. Now, here the divided by, now we want to calculate the market specific performance. Now, once we complete this residual performance part, let's calculate the market specific performance part, right? It's no longer the residual part, but yeah, this is the market part. Now, this is excess return or risk premium over the market standard deviation, right? This is almost the same concept, So let's use this. Now, where is the market risk premium? There you go. The market risk premium divided by. Now, the standard the variance of the market. How to calculate it? Right, variance now to the power of 2. So we got this performance. Now let's divide this active portfolio specific performance from the residuals and the market specific performance. If we divide this two, what does that mean? Yeah, this part is the portfolio alpha, the performance out of the market specific performance, so that we got this weight, initial position of the active portfolio. Then the beta, how to calculate the beta? Now the beta, we use some product of the beta, only the stock, comma, and the weight of the individual stock. And we got the beta of the active portfolio. So again, the point is here, let's just summarize. Once we calculate the residual variance of each securities, because that actually make the active portfolio the performance, right? So here, once we calculate the alpha of the active portfolio, then the alpha over the residual, the variances, which is the risk of this active portfolio, residual part. Now this is the performance of the portfolio, the active risk portfolio. And this part is market-specific the performance. Now, if we divide these two performance, then finally we get this, the initial performance, initial position of the active portfolio. If we do not include the active portfolio specific performance, active portfolio in this overall portfolio, then just initial portfolio in the active portfolio is exactly the same as market specific performance, which is 100% of the market, right? That's how we justify this equation. Now, let's move to the, finally, optimal portfolio part. Now, optimal portfolio can be calculated, this equation, or we can find this optimal weight of the active portfolio using the Sharpe ratio, maximum Sharpe ratio, right? Let's use this equation first. Now, the initial position in active portfolio divided by 1 plus, open the parenthesis, minus the beta, the active portfolio, times the initial position one more time, and then close the parenthesis. So 18% is the optimal risk the active portfolio alpha, active portfolios the weight. Once you got it, then the beta we already got. The risk premium, how to calculate risk premium. Now the risk premium of this active portfolio here from the stock, individual stock, the risk premium. Oh, we need to use some product of the total risk premium, comma, and the weight of these individuals. And then risk premium of this active portfolio is now 6.28%. Standard deviation, how to calculate standard deviation? Standard deviation of this portfolio is comprised of the market component and extra the return part, right? The residual part. So here, now how to calculate this? Standard deviation. We need to, right? First, in order to use this, we need to, because what we want to calculate is the standard deviation, not the variance. So the square root, open the parenthesis, now we have the beta, right? This portfolio beta to the power of 2, and we multiply we already got this, the variance of the market, variance of market, plus where is the residual variance of active portfolio? There we go. We calculate, right? So let's close the parenthesis. Now the standard deviation of this active portfolio is 90%. What is the Sharpe ratio? Sharpe ratio that is maximum under this optimal risk portfolio weight, 18%. This Sharpe ratio is now, how to calculate it? Sharpe ratio, right? Just a risk premium divided by the standard deviation. Okay, we got it. Or you can also calculate this maximum without this the equation. You can use data and the solver. The maximum max of this Sharpe ratio, highest performance, by changing the cell of this weight of optimal risk portfolio, and then solve. So, okay, it shows the optimal weight of the risky portfolio. Once you get this optimal weight, then, okay, so let's just link this weight times to each individual stock weight. And let's drag to the right. That means out of 100% over the portfolio, we include 12% of Walmart. And this is short sell, the Target and Verizon short sell. And we invest the Target, the 9.7% of the total weight, and the 46.8%, 1.16% on the GM. So that we can achieve this Sharpe ratio, 32%, with the combination of the risk premium of this active portfolio, 6.28, and the 19.07% is standard deviation. You guys understand, right? Now, let's complete overall portfolio and the market index. Here, the optimal risky portfolio, how much percentage? The total is just 100%. Is that right? Yeah. And then automatically, the weight of the market index, the 81.91%. We invest 81% on the market, the index, right? But anyway, we want to find the Sharpe ratios of this over the portfolio and the Sharpe ratios of the market index, also the beta and risk premium and the standard deviation. What is the beta? Don't have to calculate, just one. And the risk premium of the market index, we got it here. And what is the standard deviation? We got this standard deviation of the market index here. And then the Sharpe ratio is the risk premium divided by the standard deviation. Wow, the Sharpe ratio of the market index is 49.75, which is way higher than the active portfolio is Sharpe ratio. That's why we only include 18% of the total the weight out of the total weight. But anyway, by including this active portfolio, then we can also maximize the Sharpe ratio, right? That's how this index model works. First, again, this Sharpe ratio, including this very low level of active portfolio Sharpe ratio, that will increase Sharpe ratio even higher than this market index Sharpe ratio. So let's go to the beta calculation first. Beta, once we got this weight of the market index portfolio and the weight of an active portfolio, then we can just use this weight times the beta plus this weight times the beta. So the beta of this overall portfolio is 0.93. Risk premium, also the same process. How to get this risk premium? Right, we have the weight times risk premium of market index and the weight of an active portfolio times the risk premium of the active portfolio. So the risk premium is now slightly lower because the risk premium or excess return of active portfolio is 6.28 and the market index is 6. Now the overall portfolio based on this weight allocation, now we have 6.05%. Now the standard deviation must be lower, right? That increase this Sharpe ratio. So standard deviation, how to calculate standard deviation? Now, we need to develop this equation with this the weight of the market. There's no the beta of the market because it's just one. The weight of active portfolio and beta active portfolio and the variance of the market, and then finally the weight of the active portfolio with the residual the standard deviation to the power of 2, then the variance of the residual. So here that is the variance of the portfolio, but we need to definitely use square root so that we got this the standard deviation of the overall portfolio. So again, how to get it? So let me put here one more parenthesis. The weight, right? Exactly this formula. Weight plus now this weight times, where's the beta of the active portfolio? There you go. Close the parenthesis to the power of 2. And then multiplied by, okay, here you go. The standard deviation to the power of 2 of the market index. We complete this half part, right? And plus, let's move to the active portfolio residual part. Now the weight of active portfolio to the power of 2 multiplied by, we have the variance of the residuals. Here we already have this one, right? That's why you don't have to we don't have to the scale this part. Now let's just close the parenthesis. I think it produce the standard deviation now 11.72. Sharper ratio, finally, how to get it? Right. Now we have 51, which is highest, right? It's higher than the market index. Okay, so we complete this, the index model. Again, the starting point is the understanding these risk parameters related to the market. Understanding standard deviation of the systematic component, and then also the standard deviation of residual part that represent the active portfolio, right? Active portfolio. Once we calculate the covariances here, now we also understood this risk premium, right? Risk premium from this alpha, the given. And here, this optimal risk portfolio, again, this part is for the active portfolio portion, right? That generate its risks and alpha from the residuals. Once you got this active portfolio specific performance, now we need to get this market specific performance. The ratio is now the weight, right? Weight of alpha, the active portfolio. And then once we got this beta based on this scale, the initial position of the securities from the beta with just a sum product. And then finally we got this, the optimal risk portfolio using the solver or this equation, right? Once you finish it, and then you calculate the risk premium standard deviation that maximizes these Sharpe ratios and the beta of the beta risk premium standard deviation Sharpe ratio of the market. And then finally, we got this the risk premium standard deviation and Sharpe ratio of the overall portfolio. Okay, so see you in the next video clips. You guys, bye bye.